David F. Swensen, Pioneering Portfolio Management, an Unconventional Approach to Institutional Investment, fully revised and updated. Pioneering Portfolio Management takes you on an insightful journey into the world of institutional investment, specifically focusing on endowments and the role they play in ensuring the long-term strategic independence of an institution. With expert guidance from author David F. Swensen, this summary delves into the inherent conflicts and considerations in endowment management, the importance of establishing an investment philosophy, and crucial tools and strategies for managing your portfolio. As you explore the art and science of asset allocation, you will learn how to work with traditional and alternative asset classes and understand the significance of smart governance in creating a sound and well-structured investment portfolio.
The significance of endowments for institutional investments. Endowments are gifts given to universities by donors, with the principal capital designed to be untouched and only the interest to be spent. This ensures the institution's long-term strategic independence, as opposed to accepting assistance from external sources. Endowments also allow donors to specify which area of the institution they wish to see their financial gift go toward, all while ensuring the university can maintain its control over its strategy and direction in allocating resources. To understand how to manage institutional investments, one must first appreciate the importance of investments, particularly endowments. An endowment is a special means of financially supporting a university in perpetuity, for as long as the institution exists. They are designed to ensure long-term strategic independence for institutions, which is vital, considering the consequences of accepting aid from external sources. These external financial backers may have their own agenda for the institution, and their help often comes with strings attached as to how the money is spent. As a result, accepting external aid may lead to a loss of control of an institution's strategy in allocating resources. The unique aspect of endowments is that donors specify which area of the institution they wish to see their financial gift go toward, such as financial aid for students. The principal amount of the endowment remains untouched, and only interest is spent, meaning the financial support will be in place for decades or even hundreds of years. Over time, as the influence of the donor decreases, institutions can use their endowments to maintain their freedom in directing themselves without outside interference. Therefore, endowments play a crucial role in maintaining an institution's strategic independence. Balancing long-term growth and short-term stability. Endowment managers have two primary objectives: preserving the long-term value of the endowment asset and providing a steady flow of funds to the institution each year. These objectives can be at odds with each other, as the asset must be maintained over a long period, while current beneficiaries need stable financial support. To maintain the value of the asset, high-return investments are necessary, which come with high risks and market volatility. However, if the returns are not enough to cover inflation and provide funds for the institution, the endowment manager may have to withhold distributions, compromising the institution's current activities. Balancing long-term growth with short-term stability is key for endowment managers to fulfill their objectives. Investing principles. As an investor, it is essential to develop a sound investment philosophy that will guide your decisions. This philosophy should be grounded in three critical tools that will help you manage your portfolio effectively. The first tool is asset allocation, which involves selecting asset classes and determining the proportions to invest in each. Secondly, market timing can be used to take advantage of market opportunities. Finally, there is security selection, which relates to the decision of building an actively or passively managed portfolio. Understanding these tools' interplay can lead to a successful investment strategy in both efficient and less efficient markets. The art and science of asset allocation. Building a portfolio that suits institutional needs requires both judgment and quantitative analysis. Instead of following the crowd, investors need to diversify their portfolio, so that each asset class is held in a proportion that balances its risks against its potential for gains. Sensible rules of thumb also require that they allocate no less than 5 to 10% per asset class and no more than 25 to 30%. Institutional portfolios should encompass around 6 asset classes. The distinctions between them are based on differences like debt or equity, private or public, liquid or illiquid, and inflation or deflation sensitivity. Investors must keep in mind that not all assets are easy to separate into a distinctive class, and that assets should be defined based on how they respond to the same critical variable. Traditional asset classes. Traditional asset classes are a selection of investments designed to generate returns based on market returns, rather than active portfolio management. They provide reliable returns, and are traded on broad and deep markets, offering a range of accessible choices to potential investors. Domestic equity, or American stocks, is one such traditional asset class that boasts the best long-term performance record. Holding stocks not only provides a potential expected return that aligns with institutional growth over time but also offers some protection against price inflation in the long run. However, in reality, stocks may not offer adequate short-term protection against inflation. Despite this, stocks remain a fantastic bulwark against inflation in the long run. As a type of traditional asset class, domestic equity provides a harmonious relationship between the interests of shareholders and corporate managers who control a company, as their goals often align. Investing in alternative assets. Investing in alternative asset classes like real estate, private equity, and absolute return can increase portfolio diversity, efficiency and ROI. Investment managers with good judgment and knowledge of specific markets have the opportunity to significantly boost the value of their portfolios. Absolute return investment strategy involves exploiting inefficiencies in marketable securities. Event-driven investment recognizes financial changes and how they will affect valuation. Opportunities are created because uninformed investors lack knowledge of how events affect securities valuation, leading to the selling of securities at low prices, creating opportunities for the event-driven investors. However, even with these opportunities, event-driven investment strategies cannot completely protect investors from shifts in the financial market. Effective governance for investment portfolios. The success of an investment portfolio heavily relies on its governance process. One of the key decisions an institution must make is whether to pursue active or passive investment management. Active management can be risky and requires qualified management, while passive management is more hands-off but lower risk. Regardless of the approach, portfolio management requires two groups: an investment committee responsible for strategy, and an investment staff responsible for making recommendations. To avoid groupthink, effective governance processes must promote independent and contrarian thinking within the investment team.
In pioneering portfolio management, David F. Swensen arms you with the knowledge needed to achieve success in institutional investment and endowment management. This book summary tackles key concepts such as the lifelong support provided by endowments, the dual priorities of endowment managers, and the role of investment philosophy in managing your portfolio. Along the way, you'll discover a wealth of information on asset allocation, market timing, security selection, and the crucial distinction between active and passive portfolio management. Overall, this summary equips you with a comprehensive understanding of the practices and intricacies of institutional investment, highlighting the importance of good governance and informed decision-making in building a well-balanced and resilient investment portfolio.